Tell your family to keep the popcorn in the cabinet. Movie night is postponed indefinitely, because when the financial system starts whispering to itself at 3 a.m., you don't go to sleep, you listen closely, and maybe you pace a little. Maybe you stare at a screen long enough that the screen starts staring back. While most of the world was asleep, worrying about fantasy football lineups or Sunday brunch reservations, something far more unsettling happened beneath the surface of the global markets. Nothing exploded. No alarms blared. No headlines flashed red. The system didn't break. It hesitated. And in modern finance, hesitation is far more dangerous than failure. This is Saturday, January 31st, 2026. Markets are officially closed. Trading floors are empty. The suits are gone. The lights are dim. Normally, this is the quiet part, the boring part, when clearinghouses reconcile trades, settle deliveries, and publish reports that nobody outside a very small circle ever reads. This is the plumbing of finance. Invisible, unsexy, essential. Today, that plumbing is leaking something toxic. For the past 24 hours, we've been watching data feeds from CME Group, the Chicago Mercantile Exchange, the backbone of global derivatives trading, the place where trust is supposed to be mathematical. And something is wrong. Not a little off wrong. Not we'll patch it Monday wrong. Wrong in the way that makes risk managers stop answering emails and lawyers stop using first names. Key reports aren't updating. Delivery notices are blank. Issues and stops data, the single most important signal of physical metal movement, is frozen. Fields that should be populated are filled with zeros. Timestamps are stale. The system isn't reporting reality anymore. CME says it's a technical issue. Of course it is. That phrase, technical issue, is corporate language for we do not want you asking follow-up questions. Because this isn't Netflix buffering during peak hours. This is the settlement layer of the global economy. CME spends billions on redundancy, security, and fail-safes. It does not simply forget how to count metal during one of the largest delivery cycles in recent history. Glitches do not have timing this precise. To understand why this matters, you need to know how the system is supposed to work. Every day, CME publishes two critical numbers. First, volume, contracts traded, buyer meets seller, easy. Second, issues and stops. This is where theory meets reality. This tells us how many contracts actually resulted in physical delivery. Metal changing hands, bars leaving vaults. Those two numbers must reconcile. Always. If 500 contracts stand for delivery, the report must show 500 delivery notices issued. This is not optional. This is the ledger. This is gravity. But for the past 2 weeks, gravity has been malfunctioning. We've seen volumes suggesting massive physical demand, while the delivery reports show nothing, or worse, numbers that cannot mathematically exist. And today, instead of another questionable print, the report simply didn't arrive. Silence. That's not a delay. That's a decision. If this were just a reporting bug, arbitrage systems would still function. The global price alignment between New York, London, and Asia doesn't rely on end-of-day PDFs. It relies on millisecond data. Algorithms don't sleep. But those systems are breaking too. The price spread between New York gold and Mumbai gold has exploded to roughly $283. That's not a spread. That's a rupture. That is the market screaming that the bridge between paper and physical has been damaged or removed entirely. Arbitrage is the immune system of markets. When it fails, it means liquidity is gone. And liquidity doesn't vanish quietly unless someone is hiding something. You don't obscure data when everything is fine. You obscure data when publishing the truth would cause a run. So the question becomes, what are they hiding? To answer that, you have to stop looking at what's missing and start looking at who benefits. And that brings us to a name that has been circulating quietly in cybersecurity circles for months. Salt Typhoon. Not a storm, a designation. Allegedly, a state-sponsored hacking group tied to China, already linked to penetrations in U.S. telecom networks, power grids, and municipal infrastructure. The media framed it as prepositioning digital landmines in case of geopolitical escalation. But that narrative misses the real prize. Lights going out cause panic. Ledgers going dark cause collapse. The theory now making Wall Street deeply uncomfortable is this. What if Salt Typhoon didn't hack the CME to destroy it, but to use it? Think about the modern bank heist. You don't storm vaults with guns. That's cinematic nonsense. You manipulate permissions. You alter prioritization. You change who gets processed first and who doesn't get reported at all. Imagine infiltrating the matching engine itself, a ghost protocol. Code that gives your delivery requests priority while suppressing their visibility to risk systems. Metal is released. Vaults comply. But the reporting layer shows nothing unusual. The security camera is looping yesterday's footage while the shelves are being emptied. For 2 weeks, irregularities appear. Then suddenly, the system refuses to reconcile. Why? Because reality no longer matches the database. Picture a reconciliation engine trying to square an impossible equation. The ledger says 5 million ounces should be there. The physical audit says otherwise. The algorithm doesn't know how to lie, so it crashes. And when that happens, humans step in and make a choice. Publish the numbers and trigger a global panic, or pull the plug and buy time. They chose time. 48 hours, a weekend, just enough room to search for metal that might not be there, negotiate emergency arrangements, or decide how aggressively to reinterpret the data. This isn't incompetence, this is containment. And the market knows it. That $283 gap is the tell. Physical markets in Asia are pricing reality. Paper markets in New York are pricing promises. The connection between the two, the mechanism that says these prices must converge, is broken, which means someone is holding claims to metal that may no longer exist. If you think this sounds extreme, remember, the fastest way to collapse trust in a financial system is to prove that collateral is missing, not defaulted. Missing, unaccounted for. And why would China risk something this aggressive? Because from Beijing's perspective, this isn't escalation, it's symmetry. If the US is pursuing a de facto Plaza Accord 2.0, weakening the dollar, exporting inflation, squeezing China's growth, then draining the physical collateral underpinning Western finance is an asymmetric response. No missiles, no sanctions, just mathematics. Remove the metal and the paper empire collapses under its own leverage. This isn't about crashing prices, it's about proving that the emperor's vault is empty. So now we wait for Monday. Because if the data comes back clean, this story dies quietly. But if reports are delayed again, revised, or massaged into incoherence, then the flicker we saw this weekend wasn't noise. It was the sound of a system realizing it's been robbed and deciding whether to admit it. Let's pause for a second and be very clear about what the people who actually move size already understand. The smart money isn't confused right now. They aren't debating theories on social media. They've already reached a conclusion, and they reached it quietly. The metal is gone. Not misplaced, not delayed, gone. The registered inventory number everyone keeps pointing to is fiction, a placeholder value in a database that no longer corresponds to reality. And that means the paper contracts trading in New York, the ones assumed to be backed by something solid, are now backed by little more than trust and hope. Claims on a vault that has already been raided. This is the moment where cyber war stops being abstract. We're not talking about stolen emails or leaked files anymore. We're talking about atoms, weight, mass, bars that can be picked up, moved, and retitled. And if this theory holds, if Salt Typhoon really did compromise the settlement layer, then Monday morning is not a normal open. It's not even a volatility event. It's a forensic exercise, a crime scene with fluorescent lights and uncomfortable questions. The CME is going to face an impossible choice. Either admit the data is corrupted, which destroys trust in the system, or admit the metal is missing, which destroys the price. There is no third door. There is no press release that threads that needle. So instead, reporting goes dark. Silence buys time. Silence delays panic. But silence does not stop math. And that's the problem. You can hide reports. You can delay disclosures. You cannot hide prices. Because while the exchange lawyers and IT teams were busy arguing over wording, the arbitrage systems noticed something very wrong, which brings us back, inevitably, to the number that refuses to go away. That $283 gap. This is not a rumor. This is not sentiment. This is arithmetic. Math doesn't care about technical difficulties. Math does not read CME statements. Math simply asks whether two values that are supposed to be equal are. And right now, the equation that underpins the global precious metals market, the assumption that price in one major hub must equal price in another, has returned a divide by zero error. We are staring at a $283 anomaly that should not exist in any functioning market. As of this Saturday evening, even with the main exchanges closed, prices are still being quoted. After-hours desks are active. Physical bullion networks never really sleep, and instead of converging, the divergence is widening. In New York, the paper price of gold, futures contracts that theoretically represent physical metal, is hovering around $5,200. In Mumbai, where price means you actually receive a kilo bar, the number is closer to $5,183. The difference isn't subtle. Subtract the two and you get 283. A canyon, not a crack. To understand why this is terrifying, you have to understand how a normal market behaves. In a healthy system, high-frequency trading firms act as shock absorbers. These companies spend absurd amounts of money to shave milliseconds off latency. They run arbitrage algorithms that scan every market, every second, for even microscopic price differences. If gold is 1 cent cheaper in New York than Mumbai, the bot buys New York, sells Mumbai, and locks in the profit instantly. Risk-free, scaled up millions of times a day. So ask yourself, if there's a $283 difference, what should be happening? Every algorithm on Earth should be in a feeding frenzy. Every hedge fund should be backing up the truck. That spread should collapse in seconds. It hasn't. It's been open for hours, sitting there, mocking us. Why is nobody picking up the 280/30 bill lying in the middle of the sidewalk? Because you can't complete the trade. Arbitrage isn't magic. It has steps. Step 1, buy the cheaper contract in New York. Step 2, take delivery of the metal and move it to where it's more expensive. The bots are attempting step 1, but step 2 is where everything breaks. Somewhere between the screen and the vault door, the process stops. Either the computers know, or the risk managers overseeing them know, that if they buy those New York contracts, the metal will never arrive. They know that technical issues is polite language for insolvency risk. If you pay $5,200 for a contract and are forced into cash settlement because there is no gold to deliver, the trade collapses. You're left holding paper while the real market runs away from you. So the kill switch gets flipped. Liquidity providers step back. The risk is no longer quantifiable. It's infinite. This is what it means when arbitrage dies. And when arbitrage dies, the idea of a single global price dies with it. What we have now is a New York price that is theoretical and a Mumbai price that is real. One is a number on a screen. The other is the cost of actually getting metal. The US market has become an island, a store advertising televisions for $10 with empty shelves. The price looks great. The product doesn't exist. That price is a ghost. And this isn't isolated to gold. Look at silver. The spread between the London spot market and the physical market in Hong Kong has blown out to roughly $13. $13 on a metal that usually trades with a spread measured in cents. That's more than 10%. That's not friction. That's a barricade. This tells us the metal is trapped. Silver in Hong Kong isn't moving. It can't leave. And silver in London can't get there fast enough to close the gap. If you have metal in Hong Kong, you're not selling it into London because the London price is clearly wrong. So flow stops, velocity drops to zero. This is what a systemic seizure looks like. Liquidity is the blood of the financial system. When it stops circulating, tissue starts to die. We are watching the paper pricing mechanism fail in real time. That $283 gap is not a curiosity. It's an insolvency premium. It's the market charging you extra for the risk that the system backing those paper prices is hollow. So why now? Why did arbitrage fail today of all days? Why is the metal stuck in Hong Kong? This isn't just market behavior, it's legal warfare. To understand why the bridge is broken, you have to look at the other side. While the CME in Chicago is dark due to technical issues, something very convenient is happening in Asia. Major bullion banks in Hong Kong have decided that this weekend, right in the middle of a global liquidity event, is the perfect time for emergency system upgrades. Traders on the ground are reporting that HSBC Hong Kong and other custodial vaults have effectively frozen operations. Try to withdraw physical silver today. You can't. Try to allocate gold for export. It's pending. The reason given is cybersecurity maintenance, compliance updates, the usual bureaucratic fog. But this isn't maintenance. This is a lockdown. On January 1st, 2026, Hong Kong enacted the Protection of Critical Infrastructure Ordinance. It flew under the radar at the time. Today, it's the most important document in the market. The law grants authorities sweeping powers to freeze or take control of systems deemed critical infrastructure during a cyber threat. That includes financial clearing systems, settlement layers, and precious metals vaults. Now connect the dots. A cyber incident allegedly hits the US settlement layer. The CME goes dark. Hong Kong declares elevated cyber risk due to global instability. The ordinance is invoked. Vaults are locked for safety. No withdrawals, no exports. It's perfect. Nobody has to admit a shortage. Nobody has to say the silver is gone. They're not defaulting. They're protecting you. Just a temporary pause. A few days. We need to scan for malware. Meanwhile, every ounce sitting in Hong Kong is effectively hoarded. Metal checks in. It doesn't check out. A roach motel for precious metals. That's why the silver spread is $13. The market knows the metal is trapped behind a digital iron curtain. London is screaming for supply. Hong Kong is shrugging and pointing at a locked screen. And while all this is happening, ownership is being quietly retitled. Western custody to Eastern reserves. No headlines, no alarms. Just paperwork. The timing is too clean to ignore. U.S. reporting goes dark the same weekend Hong Kong locks the gates. A coordinated pincer move. The West hides the emptiness. The East secures the hoard. And stuck in the middle is a global supply chain that just seized up. Now think about Monday. If you're short silver, you're not sleeping. To close your position, you need metal, or you need to buy it back. But the exits are gone. CME is opaque. Hong Kong is locked. London is dry. You're inside a burning building, and every stairwell is blocked. The pressure is building in the pipes. At this point, the system has painted itself into a corner. There's no physical release valve left. The metal isn't moving, it isn't flowing, it isn't responding to price signals the way a functioning market is supposed to. And when the physical asset can't move to correct the imbalance, there's only one variable left that can adjust. The paper price. The number on the screen has to do all the work. And that number doesn't creep higher politely. It jumps, it gaps, it goes vertical, because it's trying to represent something that has become effectively unobtainable. That's why we're now staring straight at the possibility of a force majeure event. That phrase gets tossed around casually, but it's one of the most dangerous clauses in any financial contract. Force majeure is the escape hatch. It's the part that says, if something extraordinary happens, a war, a natural disaster, a cyber attack, and delivery becomes impossible, we reserve the right not to deliver at all. Instead, they settle in cash, and that's where the real fight begins. Because cash? At what price? Do they settle contracts at the paper price in New York, the one still pretending everything is normal at around 5,200? Or do they settle at the real price, the physical price, in Mumbai, north of 5,480 and rising? That $283 difference isn't a rounding error. It's the battlefield. And the legal war over which price is legitimate could become the most vicious financial dispute of our lifetime. That war doesn't start someday. It starts the moment the bell rings on Monday. Look at what we already have on the table. A broken reporting system in Chicago, a shutdown in the largest physical hub in Asia, a gold spread that violates basic market physics, and a growing realization among professionals that this wasn't an accident. This was the opening move of a reset. So what happens next? What happens when electronic markets flicker back on Sunday night and the algorithms wake up to discover that liquidity isn't thin, it's zero? We need to talk about timing, because timing matters here. Right now, we're in the eye of the storm. It's Saturday night. Screens are frozen. CME pages still show reporting errors. Hong Kong vaults are still under maintenance. Nothing's moving, which creates the illusion of calm. But this calm isn't stability, it's pressure. And pressure doesn't disappear on its own. In less than 24 hours, when Wellington opens and the Globex session kicks off, the world unpauses. But it doesn't resume. It snaps. You have to understand the mechanics of a blocked market. Normally, price pressure is released gradually. Prices rise, sellers appear. Prices fall, buyers step in. It's a pressure valve system. But right now, that valve is welded shut. Gold has a $283 spread. Silver has a double-digit spread. The ledger is broken in the west. The vault is locked in the east. There's no mechanism left to smooth this out. So when trading opens, the price can't glide higher. It has to teleport. My expectation for Sunday night is blunt and uncomfortable. We are likely to see a violent repricing. Silver could gap up $20 in minutes. Not 20 cents, $20. And not because of speculation. This won't be a bullish sentiment trade. It will be panic covering. Put yourself in the shoes of a short seller. You're a mid-sized fund. You're short 500 silver contracts. You went home Friday feeling clever because silver collapsed into the 90s. Then the weekend hits, CME data goes dark, Hong Kong locks down, the physical spread explodes, and suddenly it dawns on you that you're short something that may not exist in deliverable form. If you don't cover immediately, you risk being forced to deliver physical metal you cannot source at any price. That's not a bad trade. That's extinction. So the moment the market opens, you smash the buy button. You don't negotiate, you don't price shop, you just want out. Now multiply that behavior across the market. Everyone hits buy at the same time. And who's selling? Nobody. The arbitrage bots are offline. The miners are withholding supply because they can smell blood in the water. The dealers are locked down. So you get a wall of buy orders slamming into a vacuum. The price has to jump violently until someone finally agrees to sell. That level might be 120. It might be 140. It might be something that looks like a data error, and it will look like a glitch on the chart. But ironically, it will be the most honest price discovery we've seen in decades. Now, there's a darker path this can take, one that traders fear more than volatility itself. Force majeure. If the CME cannot reconcile ownership, if the hack has corrupted records so badly they genuinely cannot tell who owns what, they have a nuclear option. They can halt trading. They can declare cash settlement only. They can say, "We're sorry, no metal. Here's your money based on Friday's close." Imagine logging in Monday morning and seeing your silver contract settled at 90 while physical silver trades at 130 or higher in Asia. That isn't relief. That's a confession. It's the admission that the paper market failed without using the word default. And then ask the obvious follow-up. What do people do with that cash? They panic. They run to the physical market. They try to buy real metal. Except the physical market is already empty. So the street price completely detaches from the frozen exchange price. You end up with a bifurcated reality. One price on paper, another price in the real world. A futures market that technically exists, but no longer matters. Whether the hack was real, exaggerated, or a convenient cover story is almost irrelevant now. The outcome is the same. Trust is gone. The bridge is burned. The global market has fractured into competing islands. And on Monday, the people trapped on the paper island are going to rush for the boats, only to realize the boats are gone. When you see headlines blaming cyber instability for volatility, Translate them. It means the run has started. It means the shorts are trapped. It means price is scrambling to find a new equilibrium in a world where paper promises are no longer accepted as substitutes for metal. That $283 spread doesn't close gently. It closes violently. Either the U.S. price explodes upward to match reality, or the U.S. market becomes irrelevant, and the world starts quoting Shanghai instead. Now we arrive at the verdict. Strip away the drama. Strip away the jargon. Look at what this actually means for an individual. In modern finance, a cyber attack is the ultimate get-out-of-jail-free card for a bankrupt system. If a bank runs out of money, it has to declare bankruptcy. It's ugly, it's public, careers end. But if a bank gets hacked, suddenly it's a victim. Freezing withdrawals isn't a default, it's a safety measure. We're very sorry, valued customer. The funds are there. We just can't let you access them while we scrub for malware. That scrub can take days, weeks, years. That's what we're watching now. CME's technical issues aren't a glitch, they're a shield. Hong Kong's maintenance isn't an update, it's a lock. The cyber war narrative is being used to impose capital controls without passing a single law. The exits are being frozen because the building is on fire and there aren't enough extinguishers. The $283 spread is the smoke leaking under the door. If you're holding paper silver, an ETF, an unallocated account, or a futures contract, you're in the danger zone. You're holding a claim ticket for a coat check that just burned down. When force majeure hits, that ticket doesn't get you a coat. At best, it gets you cash that's losing value while the real asset trades far out of reach. The lesson of this weekend is brutal, but it's simple. If you can't hold it, you don't own it. If there's a counterparty between you and your wealth, that counterparty is now the weak link. The hack proved something fundamental. Digital ledgers can be manipulated. They can be erased. They can be turned off. But you cannot hack a silver coin sitting in your hand. You cannot erase a gold bar with a software patch. You cannot suspend withdrawals on metal you already possess. That's why the spread exists. The market is pricing counterparty risk in real time. It's saying an ounce of gold in your hand is worth hundreds more than a promise on a screen. The signal is unmistakable. The vault is empty. The exits are closing. The only safe harbor is the one you control yourself. We're entering a period of systemic partition. The West is going dark. The East is locking down. Liquidity is evaporating. And when price finally tells the truth, that truth is going to be expensive. The hack didn't create the shortage. It exposed it. Ignore the headlines. Ignore the technical excuses. Focus on the signal. The data is dark. The spread is real. And the market is telling you very clearly to get your metal out.